thank you all so much for bearing with us as we continue forward on our discussion of supply and demand, but we're going to look at it from a little bit of a different lens. So we just got done talking about elasticity of supply and demand. Now I want to talk about supply and demand as it relates to government policy, like price controls on things like rent, taxation, and all of the other fun government stuff that we love to talk about. So price controls. Price controls is a tool that the governments, both local and national governments, use in order to set the prices of things to ensure that the goods and services are fairly priced to the consumers. Okay, it's a way of preventing monopolies or other corporations from taking advantage of individuals. It prevents things like price gouging from happening. That's what the idea of price controls came from, to prevent price gouging. Price gouging is where an entity or an individual sets a price so high to the point where it just doesn't make sense. Okay, it's like totally unaffordable. And we see that when in Florida, when there's hurricanes, some gas stations will try to price gouge by setting the price of gasoline very high. Okay, because they know that there's going to be a lot of people need it, but that's called price gouging. It's technically illegal. And so the government sets price controls. They set ceilings and floors on prices. We'll talk about that here shortly. Taxes is another method for setting prices and controlling them that the government uses. So as you know, taxes help the government to generate revenue. That's how the government's able to fund public services like Social Security, Medicare, Medicaid, schools, roads, all of the infrastructure that our country has. The way that we fund that is through taxes. And we collect taxes from the citizens, and we use tax money to pay for things, basically. And of course, government uses taxes to influence market outcomes. When the government sets taxes on certain goods and services, it influences the sale of those goods and services in some way, shape, or form. For example, when marijuana was made legal for personal consumption in the United States relatively recently, well, not all the states, but some of them, the government set the tax rate very high on this product in order to discourage the sale of it and to generate additional revenue from it. They did the same thing for alcohol and other substances. So that's why you'll notice that the tax rates on those particular goods and services are higher than others. So what the government does is they also help to set price ceilings and price floors. A price ceiling is the highest rate or price that a good or service can be sold at. It's called a legal maximum. And this is common when it comes to things like rent, especially rent in big cities like New York City, DC, a couple of other large cities around the United States. Some local government agencies set what we call rent controls. It prevents your landlord from raising the rent past a certain percentage every year. So like, for example, in New York City, the cap, I believe, is at 5%. So the price cannot go up substantially out of control because of the price ceilings that are in place by the local government. Price floors, it sets a minimum that a good or service can be sold at. Okay, an example of this would be minimum wage laws. It would be illegal for an employer to pay an employee below the minimum wage. So how do price ceilings affect market outcomes? They're non-binding, which means there's not a direct effect on the quantity sold, which is a good thing. but it does provide constraint, meaning, especially when it comes to things like rent, it prevents the landlords from discriminating against renters because the price is capped at a certain rate, at a certain percent increase every year. And so here we have an example where a price ceiling is put into effect. So obviously, a price of an ice cream cone doesn't really have a price ceiling. But if you thought about things like rent, it has a price ceiling. So you'll notice that where the quantity supply and quantity demand equal, that we call that equilibrium, as you know. But the supply and demand cannot go above that price ceiling. It's capped, okay? If it does, it creates what we call a shortage, and there's some legality involved there as well. That's what that shows us. This has been tried with things like gasoline regulations. The U.S. government does try to put a price ceiling on gasoline. At least they did back in the 1970s during the oil crisis. But even that didn't last terribly long. OPEC, for those of you who are aware, they're oil-producing economic countries. They're the countries that produce oil. And oftentimes the price of oil and gasoline are set by OPEC, which is why we see fluctuation. So it's basically a set of, it's an oligopoly where certain countries come together and they set the price. So for gasoline, this is what it would look like when there's a price ceiling in place. We can see that the quantity of demand supply is capped out. It's not supposed to go above that price ceiling. When it does, it's temporary and it falls back below. So in big cities like New York and San Francisco, like I was talking about earlier, rent control has a big influence on things because it helps other individuals to compete to live in certain places. It's usually set by local governments. It's designed to help those who don't have as much disposable income to make housing more affordable. That's the idea. That's the way it's supposed to work. Although it's not very efficient and it's not necessarily the best way to set a level playing field. There are adverse effects on this idea. It creates shortages in housing supply, and it also causes rents to be reduced, which you think that would be a good thing, but it's not necessarily a good thing if the rent is lower than the cost of operating the building. Other adverse effects include things like supply and demand being more elastic, meaning the greater the change in price, the more affected the consumer is. Landlords are not willing to participate in rent-controlled districts because they want to be open to the free market. It's difficult to encourage individuals to move into certain cities because of rent control. It causes even larger shortages of housing. In the long run, it creates waiting lists. There's a potential for discrimination and bribery to occur in the long run when it comes to rent-controlled housing. So how do people respond to this? They typically try to let the free market dictate the rent. Although when that happens, it also leads to higher prices for rent. So yeah, it's, there's some good things and there's some not so great things with rent control. And it's difficult for people to enforce, really. So here's what rent control does: is as I mentioned earlier, it puts a ceiling on the rent, but when that happens, it also puts a ceiling on the supply and the demand, and ultimately leads to a shortage. That's what we see here. So what about the opposite? What if there's a floor price involved here, meaning the minimum that could be charged for certain goods or services? Non-binding, so there's not much of an effect on the open market. However, the binding part comes into place where there is a potential for surplus. A surplus, as you know, is when there's more of goods and services available for sale than there are buyers for those goods and services. And oftentimes when there's more of something available for sale than there are buyers for those goods and services, what we see is that the overall market price is lower, and so therefore it might go below the floor price in some cases, temporarily. An example of this being minimum wage. When minimum wage was established back in 1938, it said that no employee was able to be paid below that in order to level the playing field and establish what we call a standard of living. Now, of course, as many of you know, today in 2023, the standard of living is a lot higher than the minimum wage is. And so the government needs to consider raising the minimum wage to a livable standard. Because the current $7.50 an hour, whatever it is now, doesn't even come close to cutting it. A lot of states have their own individual minimum wage laws in place. For example, Maryland, I believe, has a $15 minimum wage across the board. So the states have their own, which are typically well above the federal minimum wage. So you'll find this statistic interesting. In the country of France, the average income is 30% lower than in the United States. The minimum wage is 30% higher. So, yeah, that's an interesting statistic. So what causes something like this to happen? Well, it's the market forces. We have more workers. Well, in France, they have more workers than they have demand for jobs. More jobs available. So the opposite of what we're experiencing here in the United States. Here in the United States in 2023, we have more jobs available than we have people to fill them with. There's currently 1.5 jobs for every person looking for work. So if the minimum wage is set above equilibrium, we will experience low levels of unemployment. High income for workers who have jobs, low income workers who cannot find jobs, creates, of course, unemployment. So that's some of the just effects on things like this. So what about teenage labor? So I think I told you all the story. I started working at the age of 15. Back then it was legal, and so I started working at the age of 15, and it was something I was very proud of. The day I turned 15, I went down to the labor office and got my working papers that said I was legally eligible for work. And so what that does is I was able to provide a living wage for myself, which I thought was a great thing at the time. I still think it is. I think I always encourage young people to work as early as they can because it provides you with skills and desire to earn a living. I think that those are all good things. Now, of course, as a teenager, I was inexperienced, just as this slide says, but I was paid a lot less. But eventually, wages went up as the more skills I gained. So this 10% increase in the minimum wage will actually lead to a slight decrease in employment among teenagers, believe it or not. And why is that? Because a lot of times the employers don't want to pay the unskilled workers, teenagers, uh, because of the things like turnover and the fact that they're still in school. So what's the effect on the overall job market when it comes to minimum wage laws? It actually leaves a gap between the quantity supply of labor and the quantity demand. So some people, want better minimum wage. Some people don't. And the difference is, those that want it are typically those who are disadvantaged and live in disadvantaged places. Which I get it. I totally agree with that. That yeah, the minimum wage should be higher for those individuals. At the same time, though, I also believe that the market should be dictating things like minimum wage. But uh, you know, this is the type of discussions that policymakers have. So, when it comes to things like the market, the markets are a great way to organize economic activity because uh, it's how we look at things in certain segments and certain areas within a market. Yeah. When it's organized that way, it helps us to identify prices and helps us to coordinate economic activities. Governments can look at improving certain market outcomes by looking at price controls, by using things like price floors, price ceilings, taxation. These are all things that the government has at their disposal to influence market outcomes. However, it's important to note that it doesn't always help the people it's supposed to help. Yeah. Governments can use taxes, of course, to improve roadways, schools, national defense, and other government entities like shoring up the Social Security. However, it's also important to understand that the amount of taxes paid are burdened by those who are working. And so the taxation often falls on a small amount of people in the society. So, what about taxes on the sellers? So, taxes are paid by both the buyers and the sellers. The buyers pay the tax to the seller remits that tax to the government. That's the way it really works, right? Now, that's why you pay sales tax. But the employer, the seller, also pays additional taxes like unemployment taxes and other forms of taxation. So we see the tax on the sellers. Of course, that tax increases with the more sales made. Yeah, that's what this shows us. The taxes on the sellers discourage certain market activity. The higher the sales tax is, usually the less it's being sold. Yeah. Uh, and oftentimes it has a negative effect on business practice. So the best way to think about this is the higher the tax, the less market activity you'll see. Tax on the buyers, same thing. So the higher the sales tax goes up, the less you're going to buy. Yeah, and that's just reality. Buyers and sellers share the burden of taxes. The higher the taxes, the worse everyone off is. Lower the taxes, better. Yeah. So anytime we see lower taxes, we get excited. It's a good thing. When the tax goes up, not so great. Yeah, because everyone shares in the burden of the taxes. Payroll taxes, as you know, are paid by the employers as based off of your earnings, and this is a tax burden that is required by the employers and to some degree the employees as well, because the employees pay federal, state, and sometimes local taxes. The employer pays unemployment taxes, benefit taxes, and the Social Security taxes. To give you an idea. So for every tax dollar that you pay, your employer usually pays two. Just to give you an analogy for that. So it's good for the labor. It's not so great for the employer. Of course, Congress has the ability to change these types of things, and oftentimes they do. Usually the tax goes up incrementally every couple of years. Sometimes not at all, but sometimes it all depends. It really depends on the situation of the country at the time. Elasticity and tax, it's inelastic. We all have to pay the tax. It doesn't matter how much the taxes go up, you're still paying them. So taxes are inelastic. Very low elasticity in some cases. But it also depends on the goods and the services that the taxation is affecting. And that's what these slides are showing us. Again, similar to what we talked about in the last chapter, the elasticity. So again, the tax burden falls on everyone. It's relatively inelastic. It might have small elasticity on supply and demand, depending on what's the tax is being levied on, depending on the products or the goods and services. In 1990, Congress adopted what's called a luxury tax on things like yachts, private airplanes, furs, jewelry, expensive cars, etc. Luxury tax is relatively elastic because you don't need it. It's not a necessity. So what's the outcome? Things of luxury came down in price. Yeah. Okay. That, my friends, is our discussion on supply and demand and how the government policies influence supply and demand. Are there any comments, questions, or concerns about this concept? Well, okay.
Can you write down the substitutions you made for the formula?
Substitutions for the formula. Which formula
Like
was that?
the first formula you were talking about, like whenever you put it into words?
Oh yeah, you're talking about elasticity?
Yes.
Yeah, absolutely. So the best way to help you to get the change in price or change in the change in quantity or the change in price is we want to take the new price minus the old price. Okay? Same with quantity. And we divide that by the old price. They'll get you the change in price, the percent change in price. Then you want to do the same thing for quantity. So it'd be the new quantity minus the old quantity. And you divide that by the old quantity. What that does is that'll give you the percent change in quantity. So you'll take the percent change in price and the percent change in quantity, you'll put that in your formula, right? So percent change in quantity divided by the percent change in price gets us the elasticity number. That help to clarify?
Thank you so much.
Yeah, you're very welcome. Absolutely. I like that better than that long, drawn-out formula. Yeah, just putting it into words makes more sense, I think. Question. there any other comments, questions, or concerns? Hopefully we did okay, right? So the good news is we got through both chapters. What does that mean for you? It means that on Wednesday, I want you to do two things for me. Oh, I apologize. I didn't mean to stop sharing. Let me reshare my screen. Okay, so two things, okay, for Wednesday. I want you to take care of this hypothesis video of price elasticity. So what you'll do is you'll open this up and, I'll fix that here in a minute. So you'll open that up, you'll watch the short video, and you'll do your annotations, just like we did back in week 2. And then you'll also have one quiz, and it covers 2 chapters, 5 and 6. And so those are the 2 things I want you to do on Wednesday. Since we covered both chapters today in our lecture, I want you to take care of both of those action items for me on Wednesday during class time. So that way it'll help to alleviate the stress that you all have from your other classes and your family life and all that good stuff. So any questions on that? No?
Nah, Professor, we good.
All right. Oh, I like that. Well, I'm glad you're good, Caleb. That's important to me. All right. I want to make sure you're good. That's, super important to me because, your well-being is extremely important. Because, there's a lot of work. So I just want to make sure that you all get it. And again, if you ever need anything, you can email me, call me, set up office hours, whatever you need, okay? I want you to remember that. I'm always here for you. So if you ever need help, just shoot me a quick note. I'll be happy to help you out. That's what I'm here for. Well, thank you all so much for your time today. Sincerely appreciate all of you. And have a wonderful night. Thank you so much. Take care. Bye.
Thank you. Good night.